You're listening to the Real Estate Runway podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, everyone. Today, we're going to get into a pretty spectacular episode with my friend Joe Robert of Robert Ventures. So this guy is super intriguing. He's actually been a real estate investor going all the way back to the 2000s. He lived through the great financial crisis. He knows what it means to make those kind of mistakes, at a young age, and it's made him a brilliant investor. Now, he now runs a fund that focuses on an interesting concept, but a sensible one, of buying non-performing real estate loans from banks, mostly on residential properties, and also investing on an equity basis into blockchain related companies that are, tech companies of the future. So without further ado, let's get right into it. But before we do, if you get any value out of the show, please leave us that 5-star review and thoughtful comment. Those ratings and reviews, we read every one, and it's exactly how we grow this show, get the message out to others. If you want to follow us on Facebook, Team Quattro Capital, one word, no special characters. And actually that's Facebook, LinkedIn, and Instagram. That's what I get for doing this off the cuff, or by visiting us at thequattroway.com. If you want to send us an email, we'd love to hear from you. Topic requests, we do answer them on the show. Podcast at thequattroway.com. And if you want to apply to be on the show, visit us at thequattroway.com/podcast. And now on to your scheduled production. All right. Real Estate Runway family, welcome to another episode of the Real Estate Runway podcast. I'm your host, Chad Sutton, and we're powered by Quattro Capital in this episode today. So here with me today on the show is my good friend, Joe Robert. Joe, welcome to the show. How are we doing today?
Chad, thank you for having me, and doing well as usual. Another day above the dirt, right?
Another day above the dirt. Well, it sounds like, if you sound as hoarse as I do, you just got over COVID. Is that what you were telling me? So
yeah, I was sick over the last week, man. The second time.
Does it get any better the second time around?
No, it's like the man cold times like 3 or 4, 5,
Oh my gosh. This is a little comedy here. Listeners, if you want something funny, my wife sent me this video called The Man Cold on YouTube. Just look for it on YouTube. It will crack you up. But it's basically it's this quote, concerned wife coming in to check on her husband with a man cold. And this is so funny, the things she's saying to him. So anyway, you have to go listen to that video. So Joe, back to it, man. Yeah. Hey, before we get into the meat of today's episode, which I'm really excited about, tell me a little bit about your background and kind of where you've been in life that got you to today, to having this fund we're going to talk about. And, what are some of your life experiences that have made you into who you are?
I mean, it's always interesting to look back over the years and see the path you take and how one thing leads to another. Definitely when I was younger, I was always kind of more on the contrarian side, throughout my whole entire life. And, it started, even with my buddies, just shoveling snow around the neighborhoods, doing landscaping work. And that ultimately led to me starting a landscaping business as in my teenage years. So as I went through high school, I was doing landscaping on the weekends and had the ability to pay my own bills, right? I want to take care of my own self. So I did that. That led me to actually 11th and 12th grade of high school. I was able to take a construction class at the tech school across the street. And that got me out of being in school half the day. So I didn't really want to be in school. So I was like, okay, I could go do this construction class, learn something, goof off, hang out with people, and get out of the regular classroom for half the day, right? And so that started giving me the skills to do construction work. So what I actually had formed was JR's Contracting and Landscaping Incorporated as a teenager. So I was kind of doing both parallel. And after I graduated high school, I went more down the path of doing construction work only. And so while I was doing this construction work, that led me at 19 to find my first piece of real estate to fix up and resell. And so that's how the real estate career started, was through the construction work and so forth. I kicked off the first property that I bought. I lived in there, I rehabbed it, and I sold it at the 2-year mark for that tax-free gain.
Yeah, that'll get you excited, won't it?
I mean, look, what was that? About 20 years ago, it definitely got you a lot more excited. Today, with the internet, man, it seems like everyone's spinning it off and doing it. But 20 years ago, no one was really doing that, right? And so, it was exciting. That kind of started, the real estate career and path.
Yeah.
Was me doing construction work and doing the work on the properties myself, and also buying and selling through the 2000s.
Pretty cool. And I think you're right. I mean, thanks to the gurus out there who made some money teaching, and some really good ones out there, not dogging that. But thanks to that, thanks to the internet, and thanks to the general dissatisfaction of the public with their mainstream, not Main Street, investing strategies, I think you're right. It's become a situation where those with the best marketing are who are winning in this business. You don't really have to be even the best at it anymore, which is a little bit scary, but I guess that's
Yeah, I mean,
how.
the information is available at everybody's fingertips, right?
Yeah.
So,
Yeah,
I mean,
exactly.
so the roll on from there, I mean, I started buying some properties in the 2000s down in North Carolina in the Outer Banks, did some small lot subdivisions, fixed up some more houses, flipped some lots. And, like everyone, the party ended too in 2000s, right?
Right.
Once the crash came, that put an end to that for a while. And so then, I was still doing construction work, and then that led me to start buying houses in the Philadelphia area again. And it was one private lender who was lending me money on that deal, who said, I'm moving my money over to someone else. And I was like, okay, I was giving him 15% at that time, which is good, right? And it's like, well, what are you doing? And he started parking his cash at another fund that was buying distressed, non-performing second mortgages, pretty much all underwater. This was about 2011. And so I started going to those meetings, and that got me very intrigued. So I actually bought a small purchase of loans, partner up with somebody in the business. He did the work and validated it for me before I dropped what I was doing on the real estate side. And once I was validated, we got our capital returned to us. Then I started buying pools of loans. We formed a partnership with two other people. And, over the last decade, we bought over like 1,500 loans, maybe about 80% of that being second mortgages and 20% being first mortgages. Yeah. So, I mean, that's that. And then 2014, me and my partner were looking for a way to escape the Northeast cold, the Philadelphia cold weather, and also get some tax benefits. So we heard about Puerto Rico. We jumped on the plane, went down there, booked an apartment, and started living there. I was there for about 4.5 years. And, while we resided there, we had made awesome relationships with the banks there and through our lawyers. So for everyone listening, definitely depending on what part of the cycle you're in will determine where you may be getting assets. And if you're in the distressed part where banks are selling assets, you're going to want to go straight to these brokers that manage relationships with banks or straight to the banks themselves. And so we've been able to buy, I think, over 150 properties in about the last 7 years there. And that's everything from residential to commercial to chicken farms, industrial, you name it, all kinds of stuff that came in the portfolios. And so that was a great experience. And that was, like I mentioned, most of the last 7 years. But as we come to the end of the cycle in the last few years, we sold most of all of our assets that we accumulated, and that kind of has ended that, and that's kind of why everyone's out there hoping now in the next few years that we see some more sell off in the real estate market and see some more better opportunity from a price standpoint.
Yeah. And before I ask some questions, I mean, what's kind of your read on that? Do you think certain things are going to cause that to happen? Or I'm just curious your read on the economy and the real estate market in general.
My thought is definitely that from a data standpoint, affordability standpoint, and all those other key points, I definitely could see where we have price correction over the next few years continuously. Now, I'm definitely seeing every market is different, and those that did go up a lot more are more subject or prone to coming down more over the next few years. But some stuff we're doing still back over here at the beach, stuff still selling under 600, under 500, like, fast. Because there's very limited inventory. All these cities where they build out in suburbia and there's a lot of inventory, I think that's where they're going to have more problems.
Yeah, that makes sense. And guys, real estate is a local game. You know that, right? You've listened to us enough on this show. You can't look at sweeping averages, but to his point, you look at what's happening in a Phoenix, Arizona already, or Reno, Nevada, compared to somewhere that is land constrained, like what he's talking about on the beach. It's all a supply and demand question, but there's also a good point of, there's the lending crisis that's coming up, right? We're not really in a buyer's or seller's market right now, in my opinion, from a real estate perspective. It's a lender's market. Entire pricing pressure, at least in the industries that we're in, is based on what one can trade debt for,
Yep.
versus the actual fundamentals of the asset. So sure, they're overpriced because we've had cheap free money for the last, 7, 8 years. But the interesting thing is going to be when some of those loans start to come due, in which case I bet Joe's fund is going to try to come buy some non-performing loans or something like that.
I mean, we have the relationships and our feet in the water, right? So if
Yeah.
that does arise, we will be bidding.
Yeah, I love it. Well, let's go focus in on that for a second. So, we haven't had many debt investors on the phone here, and so you have a unique perspective in that you've played both on the development and equity side. That's what development, acquisition, rehab from an equity
Yeah.
perspective, and you're also playing on the debt side now. So, you know, why the shift? I mean, you kind of alluded to what intrigued you about it. And B, how does it work? How does one go and like buy a non-performing loan that they're not paying and make money? Let's talk about that for a second.
Good. So why the shift? At that time, the shift was more around, it was just kind of interesting as hell, right? I mean, it was
Yeah.
kind of interesting from coming out of the 2000s where most people owed the banks money to being on the side where you actually buy the debt where people owed you the money, right? I mean, that just becomes a little bit more interesting dynamic. You know, where do people source this type of product these days? I mean, it really depends on the cycle. A lot of it obviously comes out of the banks. And when they charge off these portfolios, they're typically selling to another fund. Depending on the size of the bank, they're either selling to a very large fund or a smaller fund, or maybe it's just a local regional bank that you could go in and buy 5 or 10 delinquent loans. It
Mhm.
just depends on that size of that bank. And then, again, that if the Bank of America sells it to Bayview, $1 billion worth, then Bayview might carve it up and sell it to a smaller guy. And then that guy carves it up and sells it to a smaller guy. So you got, depending on your purchase price, depends on where you get in the line to be able to acquire these loans. But typically they can be found directly from sellers, banks, hedge funds, and brokers in the business. Those are three main people.
Yeah, that makes sense. And so the idea, if I'm reading between the lines here, the idea is, let's say someone, and I don't know, are these all single family residential loans or?
They were primarily, yeah.
Okay.
Yep.
So let's say we look at a residential loan and someone is got $150,000 loan on it and then it's non-performing, I guess is why they want it off book. So is there a certain type of reduction factor? Like how do you make money? Because you're basically taking over a loan where they're not paying anyway. So what's in it for you?
Yeah. So the high level here is whenever you're buying any type of loan, whether it's real estate, automotive, a student loan debt, anything, you're going to be buying it at a discount, right? And that's why it's
Yeah.
distressed. So, on this $150,000 scenario, let's say the property is also worth $200,000. Well, maybe you come in and you offer and purchase this loan for $100,000, right? So one, your equity is still covered. And two, you have the upside and to be able to collect on that principal that is owed of that $50,000. And that's where you make your spread. So we were buying non-performing second mortgages at initially call it 10 cents on the dollar. So we would call up the homeowner and be like, okay, you owe us, let's call it $100,000. Give us 30 grand now. Let's call it 30 cents on the dollar. And we can make the rest go away, right? So we make an increase on our money and then we do a workout for the homeowner that's beneficial for them. So it's really a win-win. And that's how you're able to buy debt. So
That
it
makes
really just
sense,
depends what's your recovery rates or what you're able to collect on that loan. Some credit card or auto trades at, 3, 4, 5, 8 cents, and they might collect 20% on the dollar on that whole portfolio.
Okay. So do you wind up displacing the homeowner at all? Or do you wind up saying, hey, we own the loan now, pay us this, we'll call it even. And do you kind of structure a new loan with them where they can actually have a chance of performing? I'm just curious how that part works.
Depends on the fund and the
Yeah.
company.
Yeah.
Everyone's got a different business strategy. So when we were buying seconds, our goal was actually keep the homeowner in the house and try to do a loan modification.
Yeah.
We didn't actually want to take back the piece of real estate. We wanted to stay in the paper business. And
Yeah.
so our goal was to try to modify as much as possible when possible.
See,
Now,
that's
some
Go ahead,
some
sorry.
people might buy first intentionally on certain piece of property that they want to own.
Yeah. See, that's fantastic because not only are you finding a way to do well, right? We always talk about doing good while doing well on this show. You're doing well in that you're buying something for less than it's worth, the loan itself. You're making a settlement that the homeowner can afford and helping them out of a bad situation. And then ideally setting them up as a new, happy, lending customer who now has a new restructured loan that they can actually service. So very intriguing. Plus your basis is good. You're not actually in it for what the original bank was, right? They just have to write off that loss.
Correct.
Very interesting. So let's jump into a little bit more about, some of the other stuff your fund is doing. So you mentioned a little bit about blockchain, and I think even something in your questionnaire about maybe some crypto underwriting or something like that. So what other like new and intriguing assets is your fund looking at on the side of paper?
Well, so I mean, to make it not sound like we're all over for everyone, but basically, most of all the loans that we purchased, we exit out of, right? They were kind of worked out. That's the downside of buying debt. Typically, it only has a certain life cycle. Unlike where a real estate, you can hold it for long term.
Yeah.
So most of that has been worked out. And so I recently put together, let me step back. So when I was in Puerto Rico, I had the opportunity to meet a lot of people in the blockchain space and tech space. And I was very intrigued because, as you can see, technology has been rolled out across all industries in the last 10 to 15 years. So I think also like AI and blockchain in certain aspects are going to also be rolled out in every business. And so therefore, we decided to get involved. We started investing 5 years ago. And recently I was like, okay, let's put together basically a debt fund where we're going to offer 8 and 10% on 1 and 3 year terms. And we're going to go out and do a blended portfolio approach with real estate we're going to acquire in the next few years, but also blockchain assets, which could include equity in infrastructure companies or certain digital assets that are part of the infrastructure. Yeah. So, our goal is to kind of, move forward is kind of create a blended portfolio a little bit different than what everyone else is used to. Most people right now, it's hard to get even a double digit return on most real estate until maybe price is correct. So we're kind of having that growth aspect of this fund. And then we're also doing the real estate side, a bit of new construction we're doing there in a certain market that I know for the last 15, 20 years, as I mentioned. And so we're very familiar with the economics and what's happening there. Yeah. And so that's why we're kind of blending the two together and kind of having two different divisions.
Yeah, well, it sounds pretty smart. I mean, so part of it is kind of a paper-backed cash flow aspect. And I would assume the blockchain related things are more like equity upside potentials are
Yeah.
probably not going to pay out immediately, but the potential is very, very high, right? If you pick that right. So how do you go about evaluating some of these, we'll just call them newer alternative assets, right? How do you look at a company that's implementing some application of blockchain and decide, do I want to be an equity investor in that?
Well, you know what it is when you typically invest in more early stage assets, it's really hard to understand exactly where things go in 5 or 10 years, right?
Yeah.
I mean, that's definitely could be the advantage, but also the disadvantage. So the advantage is because most people can't see it, they don't participate. The disadvantage is you don't know what the outcome is. And so we've just learned over the last 5 years of also making mistakes, just what is kind of working, what the market wants. We tune into what the founders are doing. As I mentioned, kind of also looking around for some more established infrastructure projects that have already been around and already have cash flow and already have revenue or just trading at discount. Because what we've seen across the stock market, blockchain, venture, et cetera, non-real estate, most of that stuff has come down, call it 50 to 90% and has already seen a price reset. So it's actually, as I see it, the best opportunity to be acquiring these assets in the next 24 months as these price resets have occurred if you're holding them 5 to 10 years out.
I love that. And that's going to lead me right into what I think is going to be your mic drop moment. But let's talk about how savvy investors triple their net worth in recessionary times, because that's really what you're positioning and what you're trying to say is like, the time to buy things is now. You just got to know what to look for. So let's talk about that for a second.
Yeah. I mean, historically, my experience has been, look, there's a saying that's, time in market, but also timing the market, right? And so us going out and acquiring assets between 2011, 2015, when people weren't talking about it and not buying these mortgages and not buying real estate gave us the opportunity to come in and buy them at this kind of price. And we held them through not quite all the cycle, but, through 2016 to 2020. And ultimately, when you find a situation like this where you could buy after assets have been sold off and hold them for a 5 or 10 year period, your probability historically has always been that you should do well, as long as you have some type of diversification in case you have one or two that don't do well. And that should be a way that you should definitely be able to triple your own net worth during these cycles.
Makes perfect sense. Do you have a microphone on your desk by chance? Could you drop it for me real quick? Because that's a little mic drop moment there. Love it. Sorry, podcaster joke, Joe. Sorry for that. So, all right, man. Well, before we let you go on the show here, I got to ask you the Quattro questions. Are you ready?
Yep. Let's
All right,
shoot.
man. All right, man. So, tell us what your superpower is and how it benefits you in life. Could be business as well.
Well, I would say, as I mentioned earlier, historically, being the contrarian, kind of going against what everybody else is doing or going, skating to where the puck is going, as Wayne Gretzky would say, right? So I kind of look at the blockchain sector as where the puck is going over the next 10 to 20 years. It happened next 24 months. People laugh at it, but once we get 10 or 20 years past it, people will be like, oh, I should have invested in it 20 years ago, right? Same as buying real estate back in 2010, 2015. People weren't all gung ho like they were the last 24 months.
Yeah.
But those people that bought real estate at that time and held it for a decade did very well.
It's a great point. Let's flip the coin here for a second, Joe. Tell me about your biggest failure, life or business, dealer's choice, and what'd you learn from it?
Yeah, I mean, when it comes to investing, definitely when I was in my 20s, as I was investing in real estate in the Outer Banks, using leverage, having leverage on lot loans, not having enough cash flow to support debt payments if the market shifted, not having enough cash reserves, definitely was the biggest lesson and the best lesson. And I'm glad it happened in my 20s and not any age older, because definitely made me a better investor and a lot smarter today.
You're absolutely right. And that's something that I think people mess up a lot is you can't eat profits, you can eat cash, right? And so if you may show a great profit and loss statement, but if you're getting eaten up on leverage and debt, and your cash bleeds out, that's a problem. And I think that problem that unfortunately that mushroom cloud is bubbling right now. So we're gonna see, talk to me again in 2024. We'll see what happens. But anyway, all right. So next question. You have a free newsletter out there. Tell us about it. Where can we find it?
Yeah, you could go to joerobert.com. You can sign up there. It's a weekly newsletter we put out. It contains investing around technology, Web3, and some real estate. We also try to maybe highlight at the bottom any articles that came out during the week that are, important or maybe tax advantaged, or what's happening in, from, like the 529 thing that just recently announced.
Yeah.
Good. Subscribe there. It's free weekly. Like I said, get some alpha, get to understand also what we're doing, information about the space.
Love it. And by the way, folks, that's joerobert.com, not Roberts. I'm sure he gets that all the time. You need to buy that domain if you don't have it already. Anyway, but folks, no worries. If you missed the S comment, scroll down in whatever modality you're listening to this on. This will be right in the show notes, one click away for you to subscribe. You won't be sorry. You'll love it. And last question, how do we get in touch with you? If our listeners want to reach out, be part of the fund, or just, talk with you more about some of your blockchain or debt investing, what's the best way to find you?
Good question there. So for the fund wise, for all those that are accredited, they can reach us on the robertventures.com. Again, that's robertventures.com. You can schedule a call with me if you're a accredited investor and discuss anything you like there. Personally, if you have questions for me, feel free to reach out. On social media. You find me, Joe Robert, no S. You should be able to find me on Facebook, Twitter, LinkedIn.
And that is Robert Ventures, not to be confused with recreational vehicle, RV. Okay, folks? So.
Yeah.
All right. Yep. Fantastic. Well, Joe, thank you so much for coming on the show. Really appreciate the interaction. I appreciate someone who's thinking about things in a contrarian way. I always have the most fun with these episodes. So I hope to have you back on soon and hear how some of these blockchain investments are treating you.
Thank you, Chad. Appreciate it. Everyone, enjoy yourselves.
Well, that was an awesome episode, listeners. If you get anything out of this show, please leave us that 5-star review and thoughtful comment. It really helps us grow the show. Hope you enjoyed the conversation with Joe Robert today, talking a little bit about some alternative investments in the blockchain world, as well as investing in debt from a debt on real estate perspective. It's an interesting way to get a good cash flow, especially if you can go into non-performing loans and get them at a good basis. So without further ado, this has been another episode of the Real Estate Runway podcast. Until next time, over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway podcast.